we are going to look at four of the most widely used technical indicators. Before we start, please make sure you share, like, subscribe to this channel. We need at least 10 likes on this video. What I'm going to be sharing today is very fundamental to your growth as an investor, and this works universally, whether you're in the US, whether you're in Nigeria, whether you're in the United Kingdom, Australia, wherever you are. There's a fundamental fact that works on a universal basis. So, we're going to look at the four of the most widely used technical indicators. Please subscribe, Wall Street charts, share with your friends and family, share on your social media, like, use the subscription button. I can't say this more than enough. So we're going to cover three things. One, what it actually measures, how traders read it, and where it breaks down. So the third part matters most because every one of these tools, they have a failure method that costs people money. So what we're trying to look at is, every time we say, oh, this is a time to buy, this is a time to sell. When we say that, we don't just say it because the weather is good, the mood is right, and let's go ahead and buy. There are a lot of things that goes on behind the scene that a typical trader, investor may not know. So this is why we want to teach you how to fish so that you can fish yourself. So you don't just depending on all kinds of gimmicks over the internet. So you can take charge of your own finance by yourself. So these tools I'm going to be sharing are descriptive tools. They are not predictive tools. Intentionally is mentioning that. So we're going to look at four of these indicators, and they are calculated from past price and volume. So we are not recommending any indicator here. We're just bringing it to your attention so that you can do your own due diligence, do your own research, and take it from there. So the disclaimer now is that this is an educational material. So I'm not a financial advisor. I'm not telling you to do whatever. So make sure you do your due diligence as you continue your investment journey. So each indicator answers a different question. For instance, when you get RSI means relative strength index. We're looking at four indicators. So let's start with RSI, relative strength index. So what it's trying to emphasize is the move stretched? What is the tension in the move? Is it extensive? What EMA, which is exponential moving average, is doing is to tell us which way is the price trending. Is it trending upwards? Is it trending downwards? Then there's a VWAP indicator. So VWAP is about what did people actually pay today to purchase that stock. That's intraday volume weighted benchmark. Then the big fish of them all is a moving average convergence division, MACD. So what MACD is trying to find out is that is it trend gaining or losing force? Is it gaining momentum or is it losing momentum? If you use four tools that all answer the same question, you have not diversified your analysis. So you just added noise and giving yourself false confidence. So what we're going to be breaking down is the core component of each of these indicators. Every indicator falls into a category. Right? We want you to see that each indicator has something peculiar to it. So you want to pay attention to what exactly each indicator is tracking, and then you have a collection of all of the indicators, and then you can build a story around them. So looking at trends, looking at accumulation volume and momentum. So these are some of the things these indicators are tracking. So momentum measures the rate of change at the level. So you can flag exhaustion early and wrong look identical in the same moment. So you want to find a common ground really in that case. So trend is just following the smoothness of the price. So trend is giving us direction. Is it going up? Is it trending upward? Is it trending downwards? So then volume weighted anchors price to where volume actually traded. So volume answers the question the momentum and trend may not be able to answer. So what volume is trying to find out is how much do people actually pay to get that stock, to get that share. So two trend following tools agrees to tell us that okay, momentum could be upward, could be downward, trend could be upward, could be downward, but momentum is the speed at which it's going up, Momentum is the speed at which it's going down. Trend is the direction. But momentum is giving us how fast is it going, tending in that direction. Volume is how much of it is going either up or going down. So very important to pay attention to those indicators. So how many indicators should I use? Perhaps you might be wondering. So the reasonable answer is that 2. For me, I use 3. I use 2 most times. I use 2. If you then, depending on your trading platform, if you use Robinhood, if you use Webull, there's a lot of technical tools that you can leverage to track movement, to track trends in your investment journey. So the relative strength index measures the speed and the magnitude of recent price changes on a fixed 0 to 100 scale. So RS, relative strength, is the ratio of average gain to average loss over the look-back period. So you have RSI is equal to 100 minus 100 divided by 1 plus the relative strength. So relative strength is average gain divided by average loss over a look-back period. So this was introduced in 1978. So because it's bounded, if you have a region of 68, it means something comparable, whether you're looking at a currency pair or a small cap stock. So that's it for relative strength index. So usually RSI, if it's around 35, 40, yeah, that means there's a sell-off. If it hits 28, that's heavy sell-off. So it might be getting ready for an uptrend. So you do this especially for blue chip companies like Nvidia, like Google, Amazon, Microsoft. Those are excellent companies that you can use that to track that. When you reach a crazy sell-off state, then you can say at the time to start building a position for an upward bounce for those companies. And if it hits 80, 70, 80, that is aggressive buy. And if it hits that level, yeah, it might come down again, but it doesn't always work like that. So there's the 70 level, which is the overbought level. There's the 50, which is like midpoint. If it hits 30 and below, it's oversold. So selling pressure is stretched at 30. Momentum is high at 70, 80, 90. Oh, crazy momentum. If you are day trading, pay attention to this, because if it's like you're at 80, 90, that is not when you want to get into a call option or you want to get into a heavy buy, because it's already been overbought. So anything could trigger a sell-off and take it back down to 50, 40, 30 RSI levels. So what is a good side and bad side of RSI? So the purpose here is to give us a balanced verdict so that you don't begin to get overconfident in your analysis journey. So on the strength side, the bounded scale is the genuinely distinctive property. It makes readings portable across assets and time frames. Everything else on that list is just about convenience. Everything else, see. On the limitation side, stayed above 70 through a strong uptrend is not an edge case. So it's what happens whenever the trend is worth trading. So that's a good time to sell. If it's at 70, 80, 90. So overbought equals sell. Overbought, yeah. If it's a choppy market, yeah, you might want to look at some other indicators to just say, okay, is it just trading sideways or is it about to get a downward trend? So use this to fight the trend and see